the question and answer section. Okay, good. So Lisa Mid can hear me, and I assume others can too. The best part about chapter 7 is that it's not that important. If you understand wave theory the way I do now, which was a lot less advanced 25, 30 years ago when I wrote my book than it is now. When I wrote my book, I assumed that you started wave patterns from the smallest time frame, daily charts, and worked your way up to longer time frames, and the smaller time frames confirmed and designed the larger patterns. But what I've realized over the last 30 years is that you really want to start from the largest time frames and work your way down. That way you're not left with all kinds of contradictory scenarios. If you start from the largest time frame and make sure that your complexity is properly managed so that you see at least 13 mono waves and no more than 55, and you begin your analysis there, then you always know that as you work your way down to the smaller time frames, they're going to agree with the bigger time frame because the scenario was derived from the larger time frame. But unfortunately, a big part of the reason my book was complicated was because I was starting from the lowest time frame and trying to show people how to build a wave count upward, and that made things a lot more complicated than they needed to be. So most of chapter 7 is about this process of compacting patterns and moving that information to larger time frames or using it to help count larger time frames. So I'll go through it, but I want you to realize that most of this can be pretty much avoided if you begin from the largest time frame, control the complexity, and as you get to the end of larger patterns, which I can show you some examples of, let me just quickly go through that. Let's see. So here's a very long-term S&P chart. It's a 2.5-year high-low chart, so it's just the highs and lows of every 2 years, plotted in the order they occurred in real time. So you can see this chart is, very manageable. It's more than 13 mono waves, is less than 55. You can see relatively clear 5-wave move, an expanding kind of pattern with the 5th wave extension. You can't see all 5 waves here because the complexity isn't quite high enough. Most likely the other correction happened here where the market topped, sold off, made a new high, and then sold off again. So this would involve a little bit of a missing wave action in here. But overall, you can see 1 is the shortest, 3 is a little bit longer. 2 doesn't retrace very much because we're dealing with a very simplistic structure. Most likely it was deeper than it appears on this chart. That's one problem you run into when you simplify. You do have problems with retracement and things like that. You can't see the full correction, fully developed, so you don't know how deep it was. You don't necessarily know how long it really lasted. So as you work your way down, you can re-verify that this does make sense by going to half-yearly charts and monthly charts. But the analysis should begin from the largest time frame and you work your way down. When you do it here, you can easily see the most violent movement has been occurring in the downward direction since the high in 2000, which tells us that the current trend is down, even though the market is drifting upward. You can see the advances are bigger, but they're much choppier and more elaborate than the much faster, more violent declines. So that's how I know that the trend is still down and how I know we're still in the correction that started at the high in 2000. But it's taking this kind of structure and realizing wave C can't take less time than wave A in a flat, so this can't be wave C of a flat. And if it were the end of a flat, then the bounce after would retrace all of wave C quicker and reach the channel quicker than it took to form, but neither of those took place. So for those reasons, I know this is not the C wave of a flat, but it's the C wave as part of a larger neutral triangle. I'm gonna actually move this in a little tighter here. Okay, so this relates to this whole structure that's not quite finished yet. And notice here we have the previous 5-wave move measured in price and time. I took that amount of time, started at the end of wave 3, because I knew wave 4 had to take at least that much time or more, and that wave 4 wouldn't be finished until at least here. So 20 years ago, I predicted that wave 4 would take at least 20 years, and we're still forming wave 4, even though we've made new highs. it's unfinished, and we still need a decline, a large decline into this, around here or later to conclude wave 4. So by looking at this structure, I know we're in this neutral triangle, and I would take this information and bring it down to a smaller time frame. So this is the process. Instead of working your way from the bottom up, I'm starting from the high and working my way down. So this right here, this very simple looking neutral triangle, which is a pattern in which wave C is the biggest, wave A and wave E will be more similar. So if you look at this, this length is the same in price, but it's just taking a little more time. And I'm projecting the D wave is going to finish somewhere around here with one more rally to new highs, which we're making now. This chart has gone off the page, so it's not showing that rally. Actually, no, it's because the year isn't over, so it doesn't show it properly. But when the year is over, it's going to change this a little bit, and eventually we should see a new high that appears on the chart somewhere in this area. That'll be the end of wave D. We'll get the E wave that'll take more time than wave A, be similar to wave A. That'll finish the neutral triangle. I'm guessing it'll be somewhere in this area. Don't know exactly, but something like this. And then after wave 4 is over, that started back at the high in 2000. Then we'll start what should be the biggest, fastest bull market of all time. But that's, probably 5 years away before it can start. Okay, so taking this structure right here and zooming in on half yearly charts would be one level down. So 2.5 years, 1/5 of 2.5 years is 6 months. So that's how I get to the half year or 6 monthly charts. And I'm taking that same neutral triangle, and you can see it in a lot better detail. And here's the D wave rally, and we're working on those new highs right now. So this is taking the bigger structure, and we're forcing it down to smaller time frames. So here's the A, the B, the C wave, which finishes higher on 6 monthly charts, the D wave, which is unfinished. So I'm taking this large scale analysis and I'm pushing it down to the 6 monthly chart. So I'm not recounting all this and beginning the process again. I'm trusting the large chart is correct, forcing the smaller chart to agree with it, and then only worrying about the last leg of that larger chart. If we go back to the larger chart, this is the only leg that's unfinished, is this D wave. So that's the leg I'm mostly focused on this 6 monthly or half yearly chart. And I'm trying to predict when it's going to finish. And the first choice when you're dealing with same degree patterns is that no leg in a pattern can take more than the last 3 legs of the same degree. So here I added A, B, and C all together. And initially, I added that to the low of wave C, not the end of wave C, but the low of wave C. And the market passed that point about a year and a half, 2 years ago. So since that was passed, that measurement had to be moved forward in time. And the second choice, instead of measuring it from the lowest low, is to add it to the end of wave C, which would be here. So it gives us about another year approximately. It could be sooner, but it gives us about another year before the D wave needs to come to an end. And that's why I have this red line there finishing right around here and then starting the decline, which looks a lot bigger than wave A, but it's actually the same size as wave A horizontally, as you can see. So that's where that analysis is coming from. So I'm making wave A and wave E the same. Wave C is the bigger wave. You can see from high to low, this is larger than wave A. And then we have the counter trend rallies, which are taking a lot longer, but the most violent movements have been down. The E wave should be similar, should definitely be more violent than this. So that's taking from the largest time frame and working my way down. And then when I go from the half yearly to the monthly, I'm going to zoom in on just this recent structure here to try to figure out how this fits in with the bigger picture. So I need to figure out where to put the X wave and what's going on since then. And that's where the monthly chart comes in. And I think it's this one right here. So in this monthly chart, here's the end of that previous pattern that is not identified on the other chart. And here's where the X wave ended. We can't finish it here because the rally was too slow. The market had violent drops, slower rallies. So it wasn't until here where it finally started rallying faster and dropping slower and smaller. So this is where the X wave actually ended. It didn't end at the low on monthly charts, even though on half yearly charts you could put it at the low there or at this little bump right there. But as you get more detail in a chart, patterns always finish later and to the right and higher, or after the high and lower. So if it's a top, they'll finish after the high and lower. If it's an advance, they'll finish after the low and higher. So here we're finishing after the low and higher, and this is where it concluded. The market's drifting up, and the market's taking off again, just as predicted in my service. I'm not sure if any of y'all listened to the video recording that I made recently. It was about a week and a half ago, before we actually had a lot of this action taking place. I was predicting that the market was going to make all-time new highs, and that we started this thrust and so forth. So this is taking that, where's that count? This is taking the 6 monthly or half yearly count, looking for the X wave, figuring out what's happened after the X wave. So I had to actually go to the monthly chart, figure out where the X wave finished. I knew it was somewhere in this territory. Looks like it's here. And then we started the new uptrend. So now we know we're in this new A wave rally of the final, ABC to finish wave D. And that D wave again comes from the larger chart between here and here. So we're probably within a year, 6 months of finishing this 10-year, 11-year rally. And when that's over, then we'll start a much more prolonged bear market. So at this moment, it appears we're going to be going up and sideways for the next few months, then go through a more severe kind of correction, maybe getting close to this low. I'm not sure how close we'll get, and then back up, sometime into the end of next year, and then we'll start a big sell-off after that. So that's the way it looks right now. And then I'm taking this scenario where the most important pattern on any larger chart is always the last incomplete wave. So when I go to weekly charts, I'm starting from here and worried about what this is, where it started, and what's forming. So we go down to weekly charts, and you can see the same neutral triangle that I have on the monthly chart, but it's a little more elaborately designed. You can see the final contracting triangle, pretty obvious on this chart, the end of wave E and the violent recovery, and then the market takes off from there. And this is the measurement I think we talked about last time, where this is the minimum price time advance for the thrust out of the triangle. It's the largest wave added to the low here, and you can see it just made it right at the tail end of the move right there. And this is on a log scale, so it performed just as required to confirm the contracting triangle. And now we're looking for the larger pattern to confirm. So what I did here is I took this neutral triangle, and neutral triangle, the thrust will be about 75%, not 100%. So I took this rectangle here, added it to the end, and took about 75% of it, which is halfway between here and the 50% point. And so that's where this projection comes from. And this vertical line here is at the apex point of this triangle. Very likely we'll make a high somewhere in here before reaction and heads back up. I don't know if it's going to peak first, react, and then finish lower, or if it's going to peak, react, and go higher. I don't know. But there's a very good chance we're going to see some kind of nice reaction when the apex point of this triangle is met, which is right about there. Okay, so that's the process that I do not describe in my book, which is starting from the larger time frame and working your way down, instead of starting from the lowest time frame and working your way up. And I can assure you, if you take this approach, making sure to manage complexity, which is the most important thing. So again, between 13 and 55 monowaves, but starting from your largest time frame and working your way down. If you do that, you will find wave analysis to be substantially easier than what you probably have been experiencing if you've tried to start from the lowest time frame and work your way up. Does anyone, it looks like I'm getting some questions already. Let me see what I'm getting here. Hold on one second. Okay, whip analogy agrees here. Okay, well, the whip analogy concept has to do with Neely River theory. It doesn't have anything to do with wave theory. So just so you're aware of that, Roy, it's a totally different concept to do with trading, not to do with forecasting. To use Fibonacci number to predict time and wave. Fibonacci analysis is mostly applicable to price movement, and it mostly applies in waves going the same direction. not waves going in opposite directions. It's just used for waves in the opposite direction to know what the minimum and maximum amounts are for, like, you know, the B wave in a flat needs to be at least 61%, but it could be 99%. The B wave in a zigzag can't be more than 61%, but it could be 38%. So it's not really used to predict, it's just used for minimum and maximum points on a price scale for counter trend moves. And when it relates to time, it's really not that useful. Regarding time, I mostly use equality for, you know, wave 1, I want wave 2 to take the same time or more. For wave A, I want wave B to take the same time or more. You don't want the B wave generally to take more than about 300% of wave A. It could be as much as 500, but somewhere in that range. You definitely don't want wave 2 to take more than about 300% of the time of wave 1, or wave 4 to take more than 300% of the time of wave 3. But Fibonacci-wise, you're not going to find it that useful. So the Fibonacci is mostly from the beginning of wave 1 to the end of wave 1, and then that amount added to the end of wave 2 to project the minimum target for wave 3. Or if you've already finished wave 3 and 4, you can then project wave 5 based on how long wave 1 looks or wave 3 looks. And we can go through some of that in the future. It gets a little, you know, there's a lot of different variational possibilities there. But just keep in mind, Fibonacci is mostly applied to wave impulsive and corrective waves going in the same direction. And usually the trending parts, A, C, and E, 1, 3, and 5, not the counter trend. But sometimes, once in a while, you'll see wave 2 and 4 relate by Fibonacci. Sometimes you'll see B and D relate by Fibonacci. Definitely you'll see wave A and C and triangles relate by Fibonacci. But it's always in waves going the same direction. Opposite directions are just not that reliable. Okay, I'm getting some more questions in here. That was answering Panchai's question. Evgeny says, just a short question with S&P, you were showing a non-limiting triangle, weren't you? Yes, that's a non-limiting triangle at the end of a complex pattern. So this is a non-limiting contracting triangle, which means when we reach the apex point, it won't be the end of the trend. It'll probably be just the end of wave A. And then we'll get a B wave and a C wave. If this were a fourth wave, this would be wave 5 and the trend would be over. If this were a B wave, this would be the C wave of zigzag and the trend would be over. But this is a non-limiting triangle, which means it's ending a larger pattern, in this case wave E of a bigger triangle. A non-limiting triangle can also be the X wave after an ABC. So you have ABC, X, and another ABC. So non-limiting just means it's not a B wave, it's not a fourth wave, and when you reach the apex point, it's not going to be the end of the trend. The market may react, but the trend will probably continue after that. Okay, so I think that answers that question. If you're going through the emails, ignore the previous emails I sent. Okay, well, just let me know, Hamid, when I get to that point. Okay, so hopefully that makes it clear to y'all how important it is for really good wave analysis. You want to start from the top down. I can't stress enough how critically important this is and how it will drastically simplify your life, drastically improve the accuracy of your forecast, and it automatically forces integration of all time frames. So you know, whatever your big count is, that all the other counts will flow naturally down from there. So you start your biggest wave count, and then only when you drop down to the next lower time frame, only focus on the last wave of the largest chart that's incomplete, and that's the wave you want to focus on the next lower time frame. And then when you do that analysis on that lower time frame, you want to find the last wave that's incomplete there and use that to go to the next lower time frame and figure out the structure there. So that's what I've done for the S&P here. We have the super long term. That's where I begin the analysis, worked my way down to the half yearly, then worked my way down to the monthly, and use that structure to force the wave count on the weekly, and then using that weekly structure where the E wave is over and we started this A wave down to daily charts, which I've done here. You can see here is the B wave, which is the minimum price time target for the thrust, which had just met it right here, right in the nick of time. And then the bigger structure is this pattern here. It's not going to be this big, most likely, because we're coming out of a neutral triangle. So the thrust only needs to be about 75%. So I need to actually adjust this. Should be somewhere right around there. And you can see we're keeping up with that rate of ascent. And these are very important things to do to keep your analysis on track, is by making these kinds of measurements, placing the rectangles on your chart, and then drawing a line from the beginning to the end so you know if the market's keeping up with it. If the market was trading over here, I would know this analysis is wrong. It has to keep up approximately with the average rate of ascent, at least through the 50% point. Otherwise, almost certain your count's going to be wrong. So if this price action had been over here before 50% was reached, I would know there's something wrong and I would consider something else. So these targets, both price and time, are very handy in helping to keep your analysis on track. Let's get started with the actual book. See, I'm getting one more question here. Yeah, let me do that later because we're going to not have a chance to finish the book otherwise. So going on chapter 7, the idea here was, after you finish a pattern, you need to compress and simplify the structure so that you can then piece it together with larger patterns. And this would be mostly useful not to go from smaller time frames upward to bigger time frames, but mostly just to do analysis on the current time frame. So you might have, let's look at an example here. You might have a pattern like this where you're working on, the 5s and 3s, and you notice that this is too small to be the same degree as this because it doesn't take enough price and not enough time, most likely. So it's probably a lower degree, and this look very similar in price, and so does this. So most likely this is a flat pattern. You would compress that into a single correction where initially you may have had a 3-3-5, and then the violent counter trend move would make this an L5, like the end. You can see I did it up here. So you have a 3-3-5. This would be the end of a correction. The violent movement indicates that the flat is over. You started a new trend. You would go through and realize that this pattern here is probably just a flat, and you have to compress this into a single 3, and then that 3 would then be compared to the move that was much bigger before. So now you have a wave that time-wise is much more similar. This time of this and this time of this they're about the same. This is a little bit bigger, I think, but they're very close. Whereas previously the drop here was too small in price and probably too small in time to be comfortably considered the same degree. It's way smaller than a third in the price and third in time. So for that reason, you have to consider it a smaller degree. And this goes back to chapter 4, the rule of similarity and balance, making sure that you're only combining similar with similar, like patterns of like degree and like complexity and like time and so forth, like price. So that way you combine the smaller patterns together before you then group them together into a singular structure. Obviously a flat breaks down into just or simplifies into just a 3. Here's the sequence here. A 5-wave move breaks or compacts into a single 5:5, zigzags to :3, flats to 3s, triangles to 3s. Terminal impulse is an impulsive pattern, so it compresses or compacts to a 5. So when you finish a flat, it compresses to a singular 3, and that then can be compared to a pattern that has a similar amount of time and hopefully is at least a third of the price. In this case, it's 3 times the complexity, but it's not more than 3 times. And it's about a third of the price, and it's about equal in time, maybe a little bit bigger. So it allows you to consider this to be a same degree, which then can be compared to this. So you have a 5 and a 3, and then probably a 5. And you could consider that a zigzag, but after the zigzag, the market didn't retrace very much. So the first assumption would be that you have a 4th wave and then the 5th wave. Now, if this were a true 4th wave, and you may want to put notes here, you would want to make sure wave 4 takes as much time as wave 3. When I wrote the book, I probably didn't understand this stuff so well as I do now 30 years later. So the diagrams aren't quite as accurate as they could be, but you might want to put a note here that if this is a 4th wave, it needs to take the same amount of time or more as this. If it's an X wave, then it's okay. But if it's a 4th wave, it needs to take the same time or more, and it should be at least a third of the price coverage of wave 3. So this doesn't quite qualify as a legitimate 5-wave move, but if it were zigzag, then the compression or compaction would happen here, where we'd have a 5-3-5. This would be the end of the zigzag. You would go into an X wave. This whole thing would become a 3, This would be a X wave correction, then you start another pattern. But if the market peaks here, and this was proper time and complexity in relation to wave 3, and it had a violent sell-off, then you would assume it's a 5-wave move, and it's the end of a completed sequence. That sequence, being an impulsive pattern, would compress or compact into a singular 5-wave move. And then working on the same chart, you wouldn't take this and force it upward to a higher degree. Working on the same chart, you would just have this simplified to a 5. And the minute a 5-wave move finishes on a chart, you know that the correction after has to take at least that amount of time. And if this 5-wave move is going to be part of a larger 5-wave move, then you also know that this drop can't be more than 61%. Because if it drops more than 61%, you either know this is not a 5-wave move, or it's the end of a larger sequence, a larger zigzag, or a larger 5-wave move. So as long as it's the beginning, let's just pretend this is the beginning of something. You have your 5-wave move, it's over. If it is part of something larger, then you know immediately, using neo-wave rules, not traditional orthodox Elliott wave rules, but you know immediately that the correction to follow is going to automatically take at least this amount of time and at least this amount of complexity. So you can go through and say 1, 2, 3, 4, 5, 6, 7 monowaves. This means the correction afterward is going to be at least 7 monowaves and at least equal in time to this, and no more than 61% of this advance, if this is going to be a correction before another advance that's going to be similar to this or related by 61%. Anyone have any questions about that? Doesn't look like it. Okay. So I can show you how I use this information on the S&P. Here is the 5-wave move we had from the low in 1982. It took almost 30, almost 20 years. So it was 18 years, everything maybe a little bit more, but around 18 years. So that's how I knew that the correction after wave 3 would take about 20 years. So I took this amount of time, added it to this high, and it stayed below or right around this high all the way until about here, and it started making new highs. That's because the pattern is drifting upward, but we're still in this 4th wave, because if we were finishing the 4th wave, we would have had a big decline into this time frame or after. We wouldn't be rallying into this time frame. Remember, when time runs out, you have to be declining to finish a correction. You can't be rallying to finish the correction. So that's how I know that we're still in wave 4. And before it's over, we need one more drop similar to wave A at the very minimum. There's an outside chance we could be in an expanding triangle and the drop could be even bigger than this, but not likely. But it's not impossible. But anyway, it should be at least similar to wave A. And that's how I know that wave 4 isn't over. That's how I know this has to be part of an ongoing 4th wave, and that we're waiting for this future event a year or so from now. So it has very useful application in real time. So if you were, let's say you were long the market as this high was being made, you could get out of the market and immediately wait this entire amount of time before you should be very interested in going long again. And from a forecasting standpoint, you could say, the market's going to go mostly sideways for whatever amount of time this was, and that it's going to retrace somewhere between 38 and 61% if the bull market's going to continue. So you can then, in case structure, you could have a rectangle that measures the price and time of this, duplicate it, start it here, take 61% of it and have it end right here approximately, and have the time end where it ends. So then you could draw a line from this high at an angle to the bottom right-hand corner of the rectangle, and you would know the approximate rate of descent that needs to be achieved to produce any kind of weak correction. If the market goes above that rate of ascent, then you know you're probably in a flat or a triangle or a correction that's not going to be very trendy, and it's just going to waste time. But the time variable has to be met before the correction is going to be finished. And this is not, a sometimes, most of the time, maybe, it's an all the time. So you can always depend on this rule applying, and that's why I'm so positive that wave 4 is not over, because we haven't reached the amount of time with a large decline. We've reached it with a large rally. We need a large decline after this time or into this time, and we haven't gotten it yet. So that's how I know wave 4 is not finished. Okay, so after this 5-wave move is finished, if it were one, you would compress this whole thing to just a :5. You would then project the minimum price time for the colon 3, and when that starts to reach its minimum price time targets, you can start paying much more attention to the individual segments, trying to figure out, are you finishing a flat, a zigzag, a triangle, or whatever, and really focus a great deal as you approach that minimum time. You want to start focusing a great deal on when and if there's a proper structure for it to finish. And then when it's finished, of course, you should be hopefully on top of it, and you'll be able to predict the next advance, which should be at least 61% of this move here, and maybe as much as 161% or more, depending on whether this is wave 1 or wave 3 or wave A or wave C. Depends on what the bigger structure is, but it should be at least 61%. And time-wise, it should be at least 61% of this. So I guess to answer one of the earlier questions regarding Fibonacci, you could use Fibonacci for same direction waves in an impulsive pattern, and you could probably use it in a flat also, where if you know the time of this move, you know the next move is going to be at least 61% of that time. So you could use it in that way, but not in moves against the trend. When it's going against the trend, you're usually dealing with 100%, 200%, 300%, not with Fibonacci relationships. Okay, so after you've gone through the compression or the compaction process, then your goal is to then figure out how it's going to build larger patterns, and begin to integrate that structure in with larger formations. This is when you might want to revisit the labeling of your pattern and reconsider the complexity. So you could look at, let me go back to the previous chart. You could look at the rule of similarity and balance in chapter 4. I'm going to have to you can look at the rule of similarity and balance in chapter 4 and make sure that whatever compressed pattern you're working with is properly relating to future patterns. So you're looking at the price, time, and complexity of those patterns on the same chart to make sure they take at least a third of the price, a third of the time, and a third of the complexity to be considered the same degree. If it's not at least a third, preferably 2 of those 3, just 1 of those 3 is not enough as a pretty major rule. So you're looking at the price, time, and complexity, and if it's not a third of the price or the time or the complexity, at least 2 of those out of the 3 should be present. If they're not, most likely you're dealing with a lower degree pattern, so you need to wait for more time to pass before you can compress or can piece together those smaller patterns to make a big enough pattern to relate back to the larger pattern. So you're trying to constantly go through this compaction process. Once you've decided something is impulsive or corrective, you simplify it to just a number 3 or a number 5, and then you wait for enough time and price to be consumed by the move after to be of the same degree as the pattern you just compacted into a singular formation. If you've just finished an A wave and you compressed it, like a zigzag, and you compact that to just a 3, then you almost always want to make sure the B wave takes more time than the A wave. And so again, you can use the same rules there. That's where the rule of similarity and balance comes in, and these concepts in chapter 7 to make sure that you're comparing like with like. As charts get more complicated, it gets more difficult to make sure that you're comparing like with like, and the human mind gets more fuzzy and flexible about things. And that's why you always want to keep the complexity of your chart down to between 13 and 55 monowaves. If it goes higher than that, you have too much freedom in the way you're interpreting things, and you might even want to keep it down to 34 monowaves, but somewhere between 13 and 55, with 55 being the maximum, because otherwise it's going to be too flexible, and you can interpret things pretty much the way you want to. That's one of the reasons that so many people find that they can't agree on wave counts. It's because they're not managing complexity, and they're not starting their counts from the largest time frame and working their way down. They're using extremely complicated, highly detailed, say a daily chart covering 5 years. That allows them to pick any high and any low they want to pick to create whatever wave count fits their personal preferences and their personal feelings. And maybe they're trying to get the wave counts to fit what they think sentiment is, or moving averages, or overbought, oversold, whatever it is. But if you start from the highest time frame and work your way down, you're not going to depend or need to depend on all those external indicators and things to help you create wave counts. This idea, dealing with complexity and degree, is just making it clear, making it, helping you understand that patterns that are highly subdivided can't be considered the same degree as patterns that are very simple if this is the same time frame in the same chart. If this is a weekly and this is a monthly, well, that's a different thing. But as long as this is on the same chart, obviously this would be a lower degree and this would be a higher degree. Degree is mostly centered around where the 5-wave moves occur. So if you have no 5-wave moves, the pattern would generally be considered complexity level 1. If you only have one monowave, it's level 0. If you have any 5-wave moves present, then that moves you up to level 2. And as the complexity gets greater, you might have 5-wave moves inside of 5-wave moves, and that moves you to an even higher complexity level. This just goes through a description of all the different ways you can look at complexity to understand it. It's not really that important. Again, if you start from your highest time frame and you work your way down, most of this is automatically managed and you don't have to worry about it. But here's an example where you have a 5-wave move, and inside of that you have a 5-wave move. So this would move this to complexity level 2 because you have a larger 5-wave move and a smaller one inside of it. Here you have a flat with a 5-wave move inside of it, and it's considered complexity level 2 for the corrective pattern. At this point, this is a little bit debatable to me, but again, it's not that important to doing good wave analysis. As long as you're making sure that your rule of similarity and balance is being met, that patterns that are smaller in price, time, and complexity aren't labeled as bigger degrees from those that take more time in price and complexity. So you're always paying attention to the rule of similarity and balance and combining patterns in that way. You really don't need to pay much attention to these concepts, in my opinion. Let's see, I think we can finish sometime soon here so that we can move on to the next. Again, this is not terribly important. I'm sure you're probably happy to know this. This would move things to level 3 because you have an entire 5-wave move, and inside that 5-wave move, you have another 5-wave move, and inside that 5-wave move, you have another 5-wave move. Again, it's not that important. When you're properly managing complexity, you probably are not going to see 5-wave moves of this kind of elaborate design, so it's not going to be an issue, and it's not going to really have an impact on whether your count's correct or not. So focus on managing complexity, starting from the largest time frame, working your way down, not worrying about what complexity level something is titled. Now, as far as degrees are concerned, the best way to manage that is just to begin from your largest time frame, and whatever is the largest possible pattern you can make, the largest individual waves that are not where there's one still unfinished, I would call that grand supercycle degree. It might be a yearly chart, 2.5-year chart, 6-month, whatever is the largest time frame you can put together. And then the next lower degree would be supercycle, then cycle. But this is all very subjective. It's not terribly important. When you're discussing patterns in maybe a publication like a newsletter or in a book, or you're talking about it over the internet or over the telephone, this might be somewhat important or useful to say, look at the grand supercycle degree and it's labeled in a certain way. But for the most part, I just make the bigger degrees bolder and larger, and the smaller degrees smaller and not so bold. I might put some in parentheses. You just want to make it clear when you're marking your chart that the bigger degrees just look bigger and look more important than the smaller degrees. So here I have, the really big degrees are in circle and they're bold, and the smaller degrees are smaller and bold, and then the next lower degree is just not bold and they're even tinier. That's all that's important. You just need to visually know by looking at the chart which ones are the bigger degrees, the next bigger degree, and the smallest degree. You want it to be visually obvious. What you call them is really not that important. Let's see. In the very beginning of the book, we talked about, what is a wave, and we talked about it as being the movement between one change in price direction to the next and on a monowave basis. But as you get more sophisticated, you realize that a wave is actually the movement between any progress label of the same degree. So you have wave A and wave B. The distance between those two is a wave. Wave 1 and wave 2, or wave 2 and wave 3. As long as it's well formed and follows all the rules, that move from 2 to 3, 3 to 4, 4 to 5 is a wave. So that's the generic description of a wave, but it couldn't be explained in a generic way until much later. Most people start off right off the bat in their books assuming you know what a wave is, but they don't even describe what it is. So sort of crazy, but that's the way it is. This diagram is basically a breakdown of my entire book up to this point, going through all the processes just to show you visually what you should do. A lot of this, again, is not necessary. You'll probably be happy to know if you begin from the largest time frame and work your way down, and always only go to the lower time frames when you're starting with the last wave on the larger chart that's incomplete, and then moving that to your smaller time frame and beginning your smaller time frame there and stretching it out and managing the complexity again on the smaller chart. If you do that, a lot of this is just not necessary. I'm sure you're happy to hear that. Okay, so let's go to the questions here. Let's see, Evgeny, I'm not sure if we went over this last time. I think we may have run out of time. So let me go ahead and unlock your mic here. Okay, it's unlocked. So
Yes.
did we cover this last time or not?
No, I guess not. Well, partially, probably.
Okay, so what's your question? Can you ask this again? Because I'm not quite sure what you're asking here.
So if there are a couple of waves which are labeled as column 3, and one wave is retraced by another wave, which is a contracting mono wave, or contracting triangle, sorry. So the way we should measure this retracement is by wave A or by wave E.
Oh, I see what your question is. Okay, yeah, no, you want to measure from the highest to the lowest point. Okay, so a contracting triangle frequently will have its most violent, well, it always has its most violent wave first, and that wave may be more than 61% of the move before it. Let's say you have, wave A up, and the A wave of the contracting triangle is 80% of wave A.
Mm-hmm.
That's the amount of retracement, even though its conclusion might be around 61%. So as far as determining the previous move, if it's more than 61%, it's telling you the previous move was corrective, even if the triangle ends around 61% or less.
Okay, thank you.
And then what about your second question?
Well, the second is more theoretical, I guess. Meaning the term correction, and whether it refers to impulsions, and whether any market can exist without impulsive waves at all.
No, impulsive patterns are parts where the public is more involved in a trend, and corrections are periods where they're generally less involved and there's less interest in the market. So the impulsive patterns will be the larger, faster moves. The corrections will be the smaller, less trendy moves. You could maybe find a market where it's only been corrective action for a long time, but ultimately and eventually there should be some impulsive action. But corrections have to do with moves of a particular nature, not a particular direction. So corrections can go up or down, just depends on which directions the impulsions are going. But if the impulsive patterns are going up, then the threes will be obviously going down. I'm not sure if that answers your question, but
yes.
Okay.
Okay,
So I'm going to get rid of that. You can go and put your mic on mute. I don't know if Duong is in this class. I don't think he is. Okay, so I'm going to move on to Hamid's question. Let me go and unlock your mic. So Hamid, you're saying when A and B are of different time lengths, it would be half the total time of A to the end of B. Yes. So
Glenn, sorry, can you move on to the next email, please?
So I'm getting rid of this email?
Yeah, you can just get rid of that. Thank you.
Okay. Well, this one had a lot of questions. So generally, if A and B are very different in time, yes, C will almost always be half of A plus B. The second choice is A plus B equals C. So it's either A plus B divided by 2 or A plus B equals C. Those are your two choices.
Right, okay.
Okay, so I take care of that first question.
That's fine. Does it have to, what's the percentage of buffer you can get if, you can't just get, if A is 5 days, B is 10 days, and C will be 10 plus 5 divided by 2, which equals
12.5.
Yeah, so I'm presuming it's not always going to be 12.5. It can go, what,
It'll
14
be extremely close. This is not a sometimes kind of rule. This is a virtually 100% dependable rule. So if A and B are about the same, C will be equal to A plus B. If A and B are very different, C will almost always be half of A plus B. If A and B are related by Fibonacci, then it gets a lot tougher, because then the C wave is not really, the B wave is not dramatically bigger, it's not dramatically smaller. It gets harder to predict the C wave. But if the B wave is two or three times or more bigger than A, you can about bet your life wave C is going to be half of A plus B.
To the exact day, if it's a daily
Well,
chart.
I mean, again, you have to make sure that you don't have too much complexity on your chart. If you're talking about, looking at an hourly chart over 20 weeks, that's too much precision. You need to look at it where the complexity is properly managed, so that it'll be approximately right around the time. It'll probably be one dot, like one data point off, or exactly correct. It's extremely accurate.
Right, okay.
Okay.
Yeah.
So if it doesn't, by the way, if it doesn't meet, then that means you're probably not in a flat. You're probably in a triangle or something that doesn't require the C wave to be the end of the pattern. It's only when the C wave is in a flat that it's going to do that, or in a zigzag. If it's not in a zigzag or a flat, it's not going to necessarily do that.
Right, okay.
Okay.
Yeah.
Okay, so next question. So it's if I can take place in. Not sure what you mean by ZZ.
Zigzag.
Oh, when expanding flats are formed, can it take? Very unlikely, unless it's very mild, like the B wave is just a little bit above A and the C wave is just a little bit below A. That would be tolerable, but the more expansion you get, the more unlikely you'd be in a zigzag.
So if say B retraces A, by an extra 0.236, that's a no-no.
Oh no, you can't. No, you can't have a large C wave and consider it to be the B wave of a zigzag. You can't. Remember, a zigzag is a trending correction. You always want to think of wave structure as if it's a physical metal structure in space and time. So if you have part of the structure going way down, that implies weakness. So you can't immediately then have a powerful move going way up. So if your C wave is elongated in the B wave of a zigzag, then you're not going to get a zigzag. That makes sense?
So you've got A wave going up, then B, that's an expanding flat, and then you've got C after going up.
See if I can find an example here. I don't see one there. Maybe I just have to draw it on the chart. So let me just do that. Okay, so hopefully it'll let me do this. So let's say this is wave A.
Yeah.
Of course, I'm going to have to pull this up every single time. So what do you want the B wave to do?
The B wave to be an expanding flat.
Okay, so you want to see it actually subdivide then?
Yes, yeah.
Okay, so here it's making a minor, looks like, well, not yet. It's making a minor new low, and then, well, it's not too minor, but something like that.
Yeah.
That you might get a zigzag out of that. But remember, zigzag is a trending kind of pattern. So to get more strength at the end and then expect a decline of similar magnitude would be unlikely. If it was expanding like this, most likely the drop after would be 61% if it's going to be a zigzag, because you're showing strength at the end of the correction where you're supposed to be showing weakness. Now, if the C wave did this, well then yes, you're going to get a zigzag, and it's going to be a good zigzag. But the more strength you have at the end of the correction, the harder it's going to be for the market to have follow through with substantial weakness. So it's at least going to be smaller than the first move if it does this sort of thing.
Right. I was just thinking from, taking out the longs and shorts from either side to confuse the traders and, continue the market and, the continuation. Basically.
Well, I mean, whatever game's being played, who knows? But the behavior of the correction is what tells you how strong or weak the market is. So you're never going to get something like this in a zigzag, where the C wave's like this.
Yeah.
you're never gonna, this will never be a zigzag, okay? Because there's too much strength at the end here. So something else weird is going on. You might be in a triangle. This would be the C wave of a triangle, and you get a D wave and an E wave, but this is not gonna be a zigzag. Okay,
Right.
you can't have a lot of strength at the end of wave B to start wave C. Does that make sense?
Yeah, that makes sense. Thank you.
Okay, so going back to your, okay, so we're moving on to number 3 now.
Yeah.
Okay, in regards to explaining flat, can wave be anywhere from, okay, yeah. This would be almost impossible to be this large and still get the C wave to be larger than the B wave. So I would try to keep it in the 138% range, not 161, 1.1 or 1 point anything above 1 to 1.38. This is getting too much. If it gets this big, it's very unlikely you're going to break, the C wave will be bigger than the A wave. So,
Right.
Okay. Remember, you have to think in terms of strength and weakness. The only patterns that would defy this would be triangles, where in triangles you can have what appears to be a sign of strength followed by a sign of weakness, or a sign of weakness is followed by a sign of strength. That's the only pattern in which strength and weakness is pretty much ignored. All the other patterns, there has to be follow through, and it has to make sense. But only in triangles does it not have to make sense.
Right. Okay.
Okay. When square box is drawn from, okay, can you explain what you're asking here?
So basically, if you've got a motive wave and you draw a perfect square, and the first wave covers just over 25% on the y-axis, or the x-axis, does that qualify as, the similarity imbalance rule?
I mean, that, remember, just price is not enough. You have price, time, and complexity. So to be considered the same degree, you want at least 2 of those 3 to be at least 1/3 of the pattern before it. Okay, so either 1/3 of the price, or 1/3 of the time, or 1/3 of the complexity, and you want to pick 2 of those. You want 2 of them to at least meet that minimum.
Right.
If you don't have at least 2, it's probably a lower degree pattern.
Right, so it has to be 33% of the price and complexity, or the time and complexity, or whichever the 2
Right,
it meets.
just as long as 2 of those 3 are met. If only one of them is met, you're pushing your luck.
Right.
Okay.
I think I've also asked if it's in terms of non-directional wave, can the wave go just past the 50% square? Because I know you have mentioned that non-directional waves have to be, they just cover half of a box.
Well, half of the price, but usually similar time. So if you have an impulsive pattern, the way that it develops after that, if it's a corrected pattern, it's more going to be like a rectangle, half of a perfect square. So corrections are generally more like rectangles, and trending patterns are more like, perfect squares, where they're progressing about a 45-degree angle. And if you have an advance that you've encased perfectly in a 45-degree angle, the correction after that is probably going to be encased in a rectangle that's half the size of the previous square, approximately. I mean, there's some, flexibility there, but just gives you a good idea of approximately what to expect. There's no absolute 100% rule there, but it's a good rule of thumb.
Right, okay.
Okay, we're moving on to 5.
Yeah.
Okay, so in order to qualify for similar imbalance, a wave has 1/3. Yeah, so that answered the question from earlier, right?
Yeah. But are there any circumstances that disqualifies a
There's
third of a
only
square?
one situation I know of in which the rule of similarity and imbalance will not be followed, and that's in a situation called extreme alternation that happens in terminal patterns. So that's where wave 4 can be really big and wave 2 really small, or wave 2 really big and wave 4 really small, but they still have to overlap. You still have to have 5 segments that are all corrective, and then you have to have a violent move after it's over to confirm that it really was a terminal. That's the only pattern because if you've read my book, I mentioned somewhere in my book that all rules have one exception. So the exception to the rule of similarity and balance is when you're forming a terminal pattern.
Right. Okay.
Okay.
Yeah.
So what is the minimum maximum retracement? Okay, so you're saying if you have wave 1 and it's a terminal pattern, is that what you're asking?
Yeah.
Okay, well, wave 1 can't be a terminal pattern. Wave 5 can be a terminal. Wave C can be a terminal. No other wave can be a terminal pattern.
What about the diagonal pattern? You know, the leading diagonal they call it.
What I call a diagonal, I mean, not diagonal. You're talking about my competitors called what they call a running diagonal.
Not running diagonal, leading diagonal.
Yeah, leading diagonal. I mean, I personally think it's a bunch of nonsense. I've never seen any reason to ever use anything like that. It doesn't make any sense to me. I think that's their attempt to make orthodox wave theory work under situations where it just isn't working. There's no logic behind it that I can ever see. It doesn't make any sense to me. I've never had any use for it, so I don't use that.
So then, you do get the like terminal patterns that you know, people label as wave 1 or wave 8 because they do look like they're terminal patterns.
No, terminal patterns only occur as wave 5 or wave C. No other position, no exceptions, and the minute they're over, you have to get a hyper violent counter trend move. And that's how a terminal proves that it was a terminal. I don't use diagonals. This was a term Elliott used, but it was confusing because he called it a diagonal triangle, but it wasn't a triangle. It was really a 5-wave move. So I got rid of the wording because it was just confusing. So terminal makes it clear what it is. It's the last wave of something really important. Diagonal doesn't really give you that sense of something that's serious. And when you add the word triangle, it makes it even more confusing because it's not really a triangle. So I just got rid of it.
Right. Okay.
Okay. We're running out of time here, so we got to hurry up. What are the circumstances? You're talking about measuring time from high to low. Is that what you're asking?
Yeah. Like, what are the circumstances? Because you mentioned on your S&P 500 that.
Yes, there's two choices when you're measuring time. First choice is always to measure time from high to low and compare it to future high to low events. Okay, that's the first choice. Once in a while, that will not work, like what we have in the S&P. Because of the violent drops here that have been happening in the slower rallies, I know the trend is still down. I also know that because wave 4 needs to take more time than wave 3. We still have yet to have a violent drop after the time has been met. So I know we're in wave 4, but what was the question? I forgot your question now.
It's to do with the high and low and the conclusion.
Oh yeah, high low. Yeah. Right. So on this chart, you can't really tell what to do on this chart, but when you go down to smaller charts, the C wave actually ended at a higher point. On this chart, yeah, I think we ran into the same problem here. If we tried to measure the time, time ran out basically, recently for this pattern. And so it's possible maybe on a 6-month high-low chart, it's possible the high will be this year, but I think this chart actually runs out of time. I don't think it goes, yeah, this ends in September of last year. So this chart is not fully up to date anymore. And I have to have Stefan actually do what's needed to be done to update it because I can't do it myself. It's a very, it's a specially made chart just for this super long-term perspective. But when you get to 6 monthly charts, there's two choices, the low or the end. So that's the other choice. And if you measure from the low, we surpassed that time and then we made a new high. So I immediately knew, well, that didn't work. So I'm going to have to move it to the conclusion. So your two choices are the high to the low. And if that doesn't work, then from beginning to end. So I took the entire time of, A plus B plus C and added that time to the end of wave C instead of the low of wave C. And so that's our remaining choice. If the market doesn't top in the next year or so and it keeps going, then this counts wrong.
Right, okay.
Okay. Let me close that in there. Okay. What are the minimum? Okay, in triangle, almost always every wave that's next to the other one will be 61% or more of the previous one. There's some exceptions, but generally wave B will be 61% or more of A, C will be 61% or more of B, D will be 61% or more of C, and E might be 61% up to maybe 99% of wave D, but generally each wave will be at least 61% or more.
What about the time lengths of each wave?
Well, when you're, let's say you have 10 days to form a pattern and it's a flat. Well, the A wave can be 1 day, the B wave can be 6 days, the C wave can be 3 days. That's because you have 10 days and you have to have time variation in a flat between A, B, and C. If you have 10 days to form a zigzag, well, then you have to do 5 waves in 10 days. So they're all going to be 1 or 2 days. So they start to get closer. If you have 10 days to form a diametric, you have 7 waves in 10 days. They're all going to be about a day. If you have a symmetrical, they're all going to be 1 day because you only have 1 day to form 9 waves. So the time variation is dependent on what kind of pattern you're in. The more waves you have, the more similar they're going to be. So when you're in a triangle, there's going to be more time similarity, but not equal. When you have a flat, it's extreme. When you have a zigzag, it can be extreme. When you have triangles, they're more similar, but still different. When you go to diametrics, time similarity is more the rule, not the exception. And when you get to symmetricals, everything's the same amount of time, pretty much.
Right, okay.
Okay. I've seen min charts where they count as correct. A will take, say, 2 days, B takes 5, 10, takes same. Yeah, that's, you should never have wave C take the same amount of time as wave A in any kind of flat or zigzag. If they take the same amount of time, unless you're dealing with a super simple chart, you know, each wave takes one data point, that's different. But if you have a fully elaborated, detailed chart, 13 to 55 monowaves on the chart, and the zigzags consuming the majority of that time, then your A wave is going to be the shortest in time, the B wave will be next, and the C wave will be generally half between A and B, or it'll be the longest. It'll never be equal to wave A. And that can only happen in triangles, diametrics, and symmetricals. It can't happen in flats and zigzags.
I've attached an image with the email. Just wanted to ask.
There's nothing attached to. Oh, here it is. I don't like
so
opening
you'll know
these
what
kind of documents because you're sending. It worked. I didn't think it was going to work actually. Normally, it will not allow me to open these kind of charts.
I know it's complex. It's not a wave chart, but this is what I normally see. What electricians do.
I can also tell it's probably an hourly chart because it's way too violent.
I think this is a daily chart.
Really? That's surprising because this is a really, really violent move right there. So what about it?
Welcome to Bitcoin.
Oh, okay. So what about it? I don't recommend you use W's, by the way. This should be an X wave, not a W.
Yeah, I want to ask you, what's your opinion on WXYs?
Doesn't make any sense. I mean, you know, why not just count it as ABC and this is an X wave? Your X wave is not possible because the first ABC is too small. Remember, an X wave can never be bigger than the previous ABC. So this is way too large, so it's not possible. If I were looking at this, first of all, the largest, most violent move is this right here, so I would assume the trend is up. This would all be counter trend. Here again, we have the most violent move up. So probably I would assume that, I'm not sure if it starts here or here, but this would be wave A. All of this would be wave B, and now we're working on a C wave rally. I would take the time of A plus B divided by 2, project the C wave is going to finish somewhere around here, price and time approximately. That would be my instant quick assessment, but I don't like doing quick assessments because I need to know what the bigger picture is. You have to start from the largest time frame, work your way down, and I don't have the advantage of doing that here, so I can't really be sure what I'm saying. But clearly the most violent action is going up, so the trend should be considered up. So the A's, the 1s, the 3s, the 5s, the C's should be going up. All the corrective B, D axis should be going down.
He's put the purple or the blue looking ABCs of the, if you see the first A in brackets going up, the first ABC, and then you've got a B down, all the way down, and then you've got a C impulsive, which takes what, a day?
Yeah, that's not nearly enough. There's no way this count is right. I can just tell you, there's no way. So you need to start from a simpler perspective. If this is a daily chart, you need to go to a weekly or a monthly. figure out what makes sense on the larger time frame, and then work your way down. Don't start from the small time frame, work your way up. It never works. It's prone to all kinds of problems. You just should never do that.
Right. Okay. Brilliant. Thank you very much. Thank you for your assistance.
Okay. Well, let's see if I can answer any more quick questions before the day is over. That was mid. Can you please? I'm not going to have time for that today. Santosh, can you remind me about that later? Does the correction have to be the same? 1 minute. Okay, again, corrections have to take the same amount of time or more as impulsive patterns always. There's no exceptions to that unless you're dealing with a terminal pattern, but then you're not dealing with a real impulsive formation. So
does that apply to the monowaves as well? Like if the impulse has, like, say 5 monowaves, the correction, does that have also need to be 5?
It's got to have the same complexity, time, and at least a third of the price to be considered the same degree and to achieve its minimum requirements. So at least, it depends on what you're talking about. If you're talking about wave 1 and wave 2, then yes, you have these minimums that are met. If you're talking about the same degree, you can have a B wave that takes less time than an A wave in a triangle. So that's where you have to apply the 1/3 price, time, and complexity. Remember, the rule of similarity and balance is not to say it's wave 2 or wave B or wave 1 or whatever. Is to say it's potentially, not absolutely, it's potentially the same degree. If it's less than a third of the price, time, and complexity, it is not possible to be the same degree. That's all the rule is for, is to move you into the realm of possibility, not certainty. And once you know what's possible, then you can start piecing together patterns, say, well, this fits, this works, this looks like this channel's like that, this relationship's there, and you can start piecing it together. But most people don't have any idea of what the rule of similarity and balance is, and so they can have one wave that takes $1 in 1 day compared to one wave that's $10 in 10 days, and they call one wave 1 and one wave 2, and they have no idea that that's absurd. So, that's the rule. That's the reason the rule of similarity and balance exists, is to make sure you're not working with things that are impossible to be the same part of the same pattern.
Right. Okay.
Okay. Well, let's call it a day. We're running out of time, so I got to get ready for my next class. So I will speak to y'all next week. If your question wasn't answered, write it down and we'll get around to it next week.
Thanks, Glenn.
See y'all.